Let's do our call of the day now. It's Barclays downgrading Blackstone to equal weight. That is after the company limits withdrawals from its real estate fund. Shares recovering a little bit, still down 5%. We did this call, Jimmy, to highlight REITs, okay? Third worst performing sector this year, down 25% year to date. Yes, it's a tiny part of the S&P 500. Nonetheless, an important one. And we've got some good exposure here on the desk. So was this a bell going off that it's time to stay away from REITs?
It could be, but I think there's an important technical factor here, Scott, which is that the size of this fund was enormous. I mean, it almost defies description. And it became a case of how are you going to find the liquidity to come out of this when just a small percentage of a very large number decides to exit. I hate hearing this news. This is not what any investor wants to hear. I have to point out that one of the things I very much like about the public equity market, and I'm not being sanctimonious, this is one of the things I really like, is I can get in and out on a moment's notice. Nobody's going to gate me. I don't have to wait a month. I don't have to put in an application. I just hit sell. Sell.
Is it time to get out of REITs?
No, I don't think so. I don't think so. And let's make this really simple. Interest rates appear to have peaked. The time to get out of REITs, I would say, is when interest rates are going up. Now, maybe some people disagree with that, but I do think interest rates have peaked.
So you have Camden Property Trust, which is an apartment REIT.
Based in the Sun Belt, really. So where people are coming to as they're coming from the higher tax coastal states. Very good business. They've been growing their business very nicely. And again, it really comes down to the Sun Belt states. It's a great business model.
Jenny, you have a ton of REITs. Iron Mountain, National Retail Properties, Postal Realty Trust, Sabra Healthcare REIT, SL Green.
Right. So
what do you think here?
I think this is a really interesting conversation, and I'm grateful that we get to have it. One thing, we need to think about why REITs are down so much this year. And historically, the conventional wisdom, and I might be misusing that term, but the conventional wisdom has been when interest rates are going up, the bond equivalents will do poorly because they are no longer competitive. So the interest rate equivalents historically have been REITs, MLPs, utilities. Okay, so let's say that some part of the REITs share price decline this year is people saying, well, I can get 5% on a 2-year bond now. Why would I buy an equity? I think a significant portion of these stocks being down is actually from that because their businesses, the underlying businesses, are in excellent shape in many cases. So that's one thing. What you
don't think it's worries about the commercial real estate market, worried about the economy?
Let me get into that in just one sec.
Well, you got to be quick because I got to go.
I'll be as quick as I can. But here's the thing. So once you get away from the conventional wisdom, what you see is these are real businesses. And in an economy that's strong, which we're still in, to Jim's point, we're still in a strong economy, they produce real earnings and they're able to increase their rents. And that is still happening for many of these companies. If I look at my portfolio, most of them still have really decent earnings growth ahead. So then you need to look at REITs overall, commercial real estate, and you need to say there is an enormous difference. There is an enormous difference between Crown Castle, which is towers, and Sunbelt apartments. There is an enormous difference between Lamar Advertising, which I own, which is billboards, and storage. Right? There's an enormous difference between industrials and skilled nursing.
I know, but you got SL Green. I mean, that's right in the heart of the commercial real estate market.
For sure. And so here's what's in my portfolio. Government, Easterly, which is government properties, Iron Mountain, which is document storage, Lamar, which is billboards, National Retail Properties, which is standalone box stores, Postal, which is post offices, Sabra. And so you look at these collectively, and actually many of these are up on the year a little bit. And all of them are trading at super reasonable valuations. They're all pumping out between 5 and 8% dividend income. So I don't think that, here's my point on this. I don't think that you're doing yourself a service to make the broad-based statement, commercial real estate is bad. That's going to cut off your nose to spite your face. What you should do is pick through and say, hey, there is opportunity potentially in the towers right now, and here's why. There's potentially opportunity in Lamar. Where would I want to stay away from? Maybe I want to stay away from, let's see, like strip centers, strip mall centers. I don't want to go there. I'm comfortable with Lamar. Sorry, I'm comfortable with SL Green, but I'm not comfortable with Vornado. So you need to pick through and not use the broad brush on this. There is enormous opportunity, and I think that because they're down so much, this is a place where you can actually make a lot of money going into 2023. My goal was to give Jim a hard sell and get him to be a buyer of this idea.
I'm glad you went in. I mean, that was great detail. I'm glad you went into all of that. It was good.
Sorry it took so long.
That's perfectly fine. It was worth it. Let's take a look at Boeing, too. We're going to take a quick break, but want to show you shares. They are moving higher at this very moment. On reports, United Airlines is close to buying 787 Dreamliners. So we'll follow that story. Nice little pop there of some 3.25% for shares of BA.